The reason I like that is because I have more control over the value. I can go in there and I can fix a problem, increase the cash flow, and now all of a sudden the box I bought for $800 might be worth 1.1 like my neighbor.
Welcome to CREPN Radio for influential commercial real estate professionals who work with investors, buyers, and sellers of commercial real estate coast to coast. Whether you're an investor, broker, lender, property manager, attorney, or accountant, we're here to learn from the experts.
Welcome to Commercial Real Estate Pro Network's CREPN Radio, episode number 60. Weekly, we share interviews with real estate experts, passing on their experience and knowledge. Thanks for joining us this week. My name is J. Darren Gross. We're so glad you're here. In just a minute, we're going to speak with Michael Blank. Michael is an author, an entrepreneur, restaurateur, a single-family flipper, a multifamily investor and syndicator. He's a mentor, a coach, and the host of his own podcast, the Apartment Building Investing Podcast, which I highly recommend if you haven't already checked it out. In our conversation with Michael, we dive into how to get started investing, the mental challenges of investing, and what you can do to overcome the self-limiting thoughts, how he teaches his new investor students, including education and action steps that prepare his students for syndicating. I'm certain you'll find it very interesting. Before we do, though, a couple of quick things I want to bring to your attention. Now you can go to commercialrealestatepronetwork.com, and we've got our podcast there. So you can go to one spot, and you can download, or you can actually listen, download an episode, or you can go to Stitcher or to iTunes, and you can, if you type in Commercial Real Estate Pro Network in those search bars, you will, when you see our logo, it's the headphones with CREPN between the ears. Go ahead and click subscribe, and that way you'll be sure to receive all of the episodes, and you can listen anytime you choose, whether it's in the car, at the gym, or if you're out walking the dog. When you do subscribe, if you leave a comment, we'd love to hear from you. If you like what we're doing, we'd even love to hear from you more. And a little bit about myself, for those of you who don't know me, I'm an insurance broker, property insurance broker, and I'm also a real estate investor. I've been an insurance broker for over 25 years. My primary clients are real estate professionals dealing in multifamily, retail, warehouse, office, and development. I'm also a real estate investor and have been for 20 years. And it's because of this I'm always looking for more information about real estate to use my own investing and also to better support my clients. And that's how Commercial Real Estate Pro Network and CREPN Radio came about. The easiest way to reach me, you can reach out to me on commercialrealestatepronetwork.com. There's an info button there. Go ahead and shoot me a message, and I'll be sure to get back to you, or you can give me a call. And one more thing here, quick. Real estate and insurance do go together. Insurance is always a part of a real estate transaction. And if you find yourself with any problems or you need to talk through a deal, let me know. I'll do everything I can to help. In fact, a recent issue I've run into I want to share with you quick. Valuation. It's important to have your property insured for the right limit. I found that many investors only want to insure for the purchase price. And when they have a distressed property or something that they purchased at a steep discount, that may not be enough to properly insure the property. And something that I want to make sure you know, and you know, if you're a professional and you work with investors, at least you keep them aware of these things, is that all property policies are written on an actual cash value basis. That's the loss settlement clause. And actual cash value is the replacement cost, what it would cost to build it back, less depreciation. And depreciation is if you take like the life expectancy of a roof, say it's 20 years, and you've got a 10-year-old roof, you're only going to get half of what a replaced roof would cost for actual cash value. Now, I never recommend that clients buy actual cash value. It's in very, very rare cases do my clients purchase that, but it's only with full well understanding that that's what they've purchased. Most policies I find today have been endorsed with the replacement cost endorsement, and it's just a much better way to go, much more satisfying way. And plus the rate receives a discount when you do insure on a replacement cost basis and actually insure for the full value. On settlement, all policies are going to give you an actual cash value settlement at first. If you have the replacement cost endorsement in place, you will have the option to receive the additional funds needed up to the limit once you replace the property and have gone through the actual cash value numbers. If you underinsure, you're most likely going to suffer a coinsurance penalty, and that's a kind of an insurance math, but the way that it's expressed in insurance is what you did insure for divided by what you should have insured for. And that percentage is what the insurance company will take, and they will multiply times your actual loss. And so if you say you were supposed to insure for $100,000 and or actually, let's say you should have insured for $200,000, you only insured for $100,000, you've only insured for 50% of what you should have, and you have a $50,000 loss, you're only going to receive $25,000 because that's 50% multiplied times the $50,000 less your deductible. And never a good conversation to have, very easy to avoid. And the reason I bring this up is that, like I said, with investors, I've seen this many times. You buy a good deal, you get a good price, you're only in at X, and why would you insure at X plus? Well, that's the reason, to avoid any kind of penalties. And in recent years, there's been little or no inflation. I think it's been pretty well under 2% for quite a few years. But the cost to build has gone up. In fact, recently I've run some replacement cost estimates for clients, and we found that as much as half, or current values have been half of what they should be. And so I say that just to make certain that you're not looking past that. If you continue to renew your policy for the limit you had last year, you may be setting yourself up for a problem, and you don't need to do that. In fact, this is one thing I do know, is that if you're underinsured and you have a claim, you will not be happy with what you get. So don't fail to insure properly and thereby self-insure. Take the time, do it right. If you have any questions, you need some help, give me a call and I'll do all I can to help. That's what I do. All right. Lastly, before we get on with the show, if you're on LinkedIn, check out our group, Commercial Real Estate Pro Network. It's a great place to network with real estate professionals, and go ahead and check that out. All right, let's get on to the show. On the line with me today, I'm fortunate to have my guest, Michael Blank. Michael Blank is a name you're probably familiar with if you're on Bigger Pockets at all. He's a multifamily investor. He's a syndicator. He's, like I said, he's featured on Bigger Pockets. His focus is on raising money and apartment investing. He's also got a podcast, and today he's our guest. Michael, welcome to the program.
Oh, thanks so much. I'm delighted to be here.
Michael, for our guest and for myself, if you would, just kind of fill in a little bit of your background. Tell us a little bit about who you are.
Well, I'll just kind of do a broad brushstroke there, and then you can kind of drill down on whatever you want to drill down. But, I was taught to go to school, get good grades, and get a good job like most other people. And I didn't read Rich Dad, Poor Dad until it was like in my, early 30s. And by the time I actually took action, I was 35. And I kind of followed Kiyosaki's advice with real estate and a cash flow business. On the cash flow side, I got into a restaurant business and a restaurant franchise. It was set up as a passive investment, and it turned out not to be so passive. On the real estate side, I got started with flipping houses and flipped about 34 houses, got into apartment buildings, and learned the art of raising money, which I'd love to share with you today because it was a huge aha moment for me. I've raised, $1.6 million for restaurants, house flips, and apartment buildings. And now, the last 2.5 years or so, I really taught other people how to do the same thing, specifically raising money for apartment buildings with a goal of achieving some amount of financial freedom. And so I'm really passionate about teaching people, and it's a relative new thing for me, and I've really had people now become successful with the kind of stuff that I'm teaching, and that really excites me. I really love the art of a deal itself, but I really also like seeing people progress and achieve things I didn't think were possible.
Yeah, and to that, I was actually flipping around on, I think it was on YouTube last night. I found your channel. There was a couple of, actually I think there were a couple of maybe your students that were giving some endorsements on some of the deals they had, and it was impressive. I mean, these were not just I bought my first duplex. I think the one guy was talking about how he'd got into a 100+ unit deal, and there was another one. I can't remember exactly what the numbers were, but I knew that you did a fair amount of teaching. I wasn't fully aware that you were fully engaged in coaching. If am I reading that right?
That's right. It's interesting. I didn't plan on doing this. It was really people kind of made me do it, right? And it's one of the things. There is definitely a disconnect between the learning and education and the actual taking action result. And I noticed that without that missing piece of coaching, a lot of people can't make that transition. So it's really a matter of accountability and support that gets people into a habit of taking action, and as a result, people are having a bit more results, which is fantastic and very satisfying to me.
No, that's great. And like you said, it's one thing to read the book, but it's actually a whole different thing to take the training wheels off and actually, go out and do it. And to that, why don't we kind of jump in here with what I'd hope we'd be able to get talk about today. Let's talk about, and I think one of the things that I love about what I've learned about you is you teach the multifamily thing, and if people aren't comfortable with the multifamily thing, you bring it back to, well, let's get you in on something. Let's get you in the game kind of thing. And I think that's so valuable, because even when I first started investing, the only thing that I recognized, I didn't understand. I mean, appreciation was a great thing if the market was going the right way, but the only thing that drove me was that the renter was paying down the mortgage. And at the end of however long I kept that thing, there was going to be equity built in that property. That was the one thing that I could grab hold of, understood, and knew that I liked that. That was like having an employee that I didn't have to manage. It was relatively simple, and it was a concept that I could grab onto and work with. And so let's talk about somebody that has jumped into the marketplace. They've been in single families, or maybe what we start with is just differentiating between the two. But I think that there's real power in understanding or looking at the investor that's in the singles, and maybe they've done that for a while, and now it's time to challenge themselves and get into the bigger thing, and the mindset shift that they need to take hold of.
Yeah, I mean, it's a good point. A lot of people come from a single-family house investing perspective. It's, people most tend to live in houses or rent in houses. It's a comfortable thing. They're told that's really where everybody needs to start. So let me start by kind of describing the difference between the pros and cons of single-family versus multis, and then we can maybe talk about why I like one better for the other. And let me say that one size does not fit all. So my conclusion is not that single-family house investing is not good. It's bad, right? It depends. Right. But understanding the differences between the two and what your goals are very important. So, for example, let's look at affordability. Single-family house wins out because obviously much cheaper to buy a single-family house than a 20-unit, right? So single-family house wins in affordability. Control over value, right? Single-family houses are driven by comps, by the market, right? What has the house next door sold? Whether I get $100 more in my rent than the next house, no one cares, right? It's all comps. With commercial real estate, of course, it's all about how much cash does the box produce? How much cash flow it produces? The more the box produces, the more it's worth, right? So I can have one apartment building being worth $800,000 and the one next to it 1.1. Why? Because it produces more cash. So the reason I like that is because I have more control over the value. I can go in there and I can fix a problem, increase the cash flow, and now all of a sudden the box I bought for $800 might be worth 1.1 like my neighbor. So I have more control over value, and I don't have that in single family. Finding deals, another criteria. Single-family houses, since there's many more, it's much easier to find a single-family house rental than a multifamily. So single-family house wins that category. Property management. Property management is built into the multifamily business model. It's very unusual for someone to self-manage, a medium or large apartment building. It's already built in, right? I like that. I like the built-in thing. Now, with houses, it's a little unnatural. You got to find. It's hard to find. And you might find a realtor that kind of does it on the side, or a small property manager. If you do find a good one, which is rare, because it's spread out, it's going to cost you more as a percentage, right? So it's not as natural. It's a little more, and a lot of people tend to self-manage because it's only only one or two or five houses, right? So they tend to be more self-managing. Let's see, I don't know, we're a 4 or 5, but ability to sell, right? I always think about exit strategy. If I have a portfolio of 25 houses, which I know people who have that and larger, if they try to liquidate that, they try to sell the whole portfolio, and it's really hard to do. It's hard to offload. It's a very, very unique buyer that's going to buy a portfolio of 25. Versus if you have 25 units under one roof and you want to sell that building, that happens every day of the week, right? It's not hard to sell a 25-unit building. So liquidating the asset is much easier on a multifamily. The last two is ability to scale. Okay, and the last two are actually related. The last one is, can whatever strategy I'm doing achieve my goals? I had a meeting yesterday with an acquaintance of mine, actually, who's now come around to investing in real estate, and he wants like $50,000 a month in cash flow. All right, fine. He's playing with a few more zeros than the average guy. That's fine. And he was going to do a rental property because a buddy of a buddy, said, here's a rental property. So I said, okay. I said, I kind of went through this thing, and I said, do you know how many houses you have to buy to make $50,000 in cash flow? Oh, this is cash flows $200-300 a month. I said, do the math. You're gonna need a gazillion single family houses.
Right.
I said, how long will it take you to get there? And he kind of went, huh. Interesting. I didn't even think about it that way, right? And a lot of people they start with this path, and we'll talk about maybe later why people think this, but they think, hey, let's start with single family, but my goal is retirement in 3 to 5 years. So, and then the other people that get started in multifamily, the ones that already have the portfolio of 50, and they're like, dude, I'm so burnt out and I can't scale. I'm so tapped out. I don't know where the time goes. I can't go beyond whatever units I have. You know what? I'm just going to sell the whole lot and get a multifamily. Why? Because I can scale it up, right? Within 2 or 3 deals, I can have 100 units. And so that allows me to scale up. So those are some of the pros and cons. And again, one's not better than the other. It just really depends on what your goals are, right?
Right.
I mean, buying a rental property 1 year for the next 10 years, fantastic retirement strategy. I mean, why not, right?
Right.
But if you want to retire in 3 to 5 years, let's say, and you want to leave a legacy for your children and build a real business out of it, and you want $10,000 to $20,000 in cash flow and build wealth, single family is just going to be much, much harder to get there. So those are some of and these are things, frankly, I didn't even think about when I got started either.
No, and I think one that he didn't touch on at all is really worth noting is just the borrowing. If you're buying single family rental investments, they're always looking at you and your ability to cover the debt, and they're only going to loan up to the value of whatever the neighbor properties, percentage loan to value of what the neighbor properties are, like you were saying, the comparables. Whereas in commercial, they're going to look a lot more at the performance of the property, and take that into account. And we'll get into the whole raising money thing. But no, I am and raise my hand. I've been doing single family for a number of years, and we've got a couple of unique properties where they're operated more like a group home kind of thing, and they cash flow substantially better than a traditional single family. And we're getting into multifamily right now, but it is a progression. And I think the thing that the challenge is that mindset. When you're in control of the property, the management, and it's a property that's down the street or across town, and you've painted the walls because you're that guy that's been the guy that'll race over there and fix the toilet or whatever it is, as that little single family manager kind of thing, as opposed to getting out of the way and having people that do that and be able to make a phone call and know that your time's worth more elsewhere, kind of thing. But really that mental shift. And maybe we can talk a little bit about that, just the difference from that investor that's doing the single family and what it takes to really open your mind. You went down kind of the list of here's where this one's better, here's where this one's better. But that's again the paper, the analysis, the columns, the plus and minuses, but really to get your mind around and to walk into that multifamily and walk away from the single family. I think that's really where I think I find a lot of people don't really have that, you know what I'm saying, as far as that real confidence or.
I used to underestimate the whole mindset thing. I just thought it was a bunch of baloney, right? The mindset, and the more I've been doing this as an entrepreneur, and now more importantly working with others and seeing how their minds are working. the more I'm convinced it all starts with mindset. I mean, let me give you some examples. And I hear this all the time. I say, I see your goals, retirement, 3 to 5 years, whatever you want to do. You're going to start with single family houses. Why? Right? And there's like one of like 4 things they'll say. They said, well, I don't have the money. So, I got $15,000, $20,000, I can buy a house. So I don't have any money, so I'm going to go to a house. Or I don't have any experience. They say start small and go from there. So, the smallest thing I can think of is a townhouse rental, right? So let me start there. The third one is they don't even know where to start, right? I mean, they can get their hands around a rental because maybe they rented before or they got a buddy who had a rental, right? So their mind kind of goes, okay, I can sort of see how to, I can go to the MLS, get a realtor, buy a house, put a down payment, and put in that Craigslist ad or something. I know how to start with that. With multifamily, I don't even know where to start, right? And then number 4 is, I don't have the time. I don't have the time to, wait 1 or 2 years to get a multifamily. I know I can walk down the street right now and buy that townhouse, and it cash flow $100, $200, and I'm good, right? So those are the 4 things. And the thing about it is they're all myths. And so it's when someone makes a decision based on incorrect information or just sheer ignorance, it's a problem, right? So my approach has been to, hey, let's look at each of ones a little bit further and let's look and see what is actually behind that and how you can actually overcome those things to the point where they're no longer showstoppers, right? So we talked about raising money. If you don't have money, well, you're going to raise money. Now, raising money is actually not that difficult. It's an acquired skill like anything else. Once you know how to do it, you have some scripts, you have a process or in a procedure, you can actually do that, right? Now, I can't go out for you and raise the money for you. You actually have to, call people, email people, and talk to people and build a relationship with them. I can arm you with the information how to do that, and you got to do it. But the point is, a lot of people, and this was one of my first aha moments I had back in 2009, was the money. When I had none of my own capital because it was all deployed in these restaurants. That was my big idea. That wasn't real estate. It was a restaurants business. Right? We can say that for another day. So I deployed my entire capital in this strategy. I mean, it was like that was my big bet. Fortunately, it didn't work out that way, but doesn't matter. So I didn't have any more capital. But in 2009, after the recession, the market recovered so rapidly in the Washington, D.C. area and elsewhere, where we had a flood of foreclosures and we had the retail market really reviving very quickly. So there was a huge spread between what you could buy it and what you could sell it for. So I just jumped in. And the only way I could do it is to raise money. And after I got my first commitment, $25,000 from, an acquaintance, I was like, wow, let me get this straight. My ability to buy houses is only limited by my ability to raise money and find deals. It doesn't matter how much money in the bank, which was nothing, right? And that, to me, was so mind-opening. And so that's kind of the first thing that I tell people is, man, think of raising money. Let me show you how it's done so you can see it. And once you see it, it won't be the same again.
No. Well, and I think, again, going back to that point, like you said, you didn't have any capital. But there are people out there with capital. I think that's one of the things that I think that people kind of have to twist the switch there and recognize there are a lot of people with capital looking for a return. Right. I mean, the stock market's not producing any big home runs right now, and people, especially retirees, or you get people with 401ks, they can do the self-directed or whatever that is. There's a lot of money out there, and I think that especially when you don't have money, that may not be your point of reference. So that's huge. And so when you went out to raise your first $25,000, I mean, it sounds like it was an acquaintance. What was your script, or I mean, how did you introduce the topic? Did you basically say, this is what I'm looking at doing? Are you interested, or how'd that go?
Yeah, it's kind of small talk, right? As I tell people, you're kind of small talk. You're like, you're not going to believe it. I'm getting into this, this real estate investing thing. In this case, it was flipping houses, but the same thing works with apartments. I'm really getting into this partner investment thing. It's really cool. I've built a team. I'm looking at properties in this area, and I'm looking for investors. That with a minimum $50,000, we're going to return between 10 and 15%. Really cool. Do you know anyone who might be interested? And they might go, well, I might be interested, or they might go, well, my dad is interested, or my boss is interested. And the whole thing with raising money is you're not really raising money. You're really networking and building relationships with people. So you're not going to go in there someone that you haven't talked to in 2 years and call them up and say, hey, I'm getting into real estate investing. You in for 100,000? Yes or no? All right.
Yeah.
They're gonna go, what the heck are you talking about?
Yeah.
Right. So you got to if you haven't talked to someone, you just have to update them on their life in general and mention the apartment thing by the by. And over the course of several weeks, as you reestablish a relationship, kind of steer it into that direction. On the other hand, if you have, your brother or friend or something, and, he kind of knows what you're up to with real estate, and you're kind of watching him from afar, but you haven't really been very intentional with the conversation, well, you can actually try to get a commitment from that person, right? You can tell them a little bit more on what you're doing, and you try to get a verbal commitment. Now, and you talked about what do you say is one of the biggest, again, this is a mental roadblock for most people is, hey, I don't have a deal under contract, so I can't go raise money. Okay, yeah, I get that. And then they go, oh gosh, I got lucky and got a deal under contract. Now I got to go get the money. I don't have the time to raise the money up. You're right too. So they're like, that's it, I'm done. I can't figure it out. Right. And my answer is, I call this the sample deal package. Okay, sample deal package. You basically create an investor package from a real deal. You create the financial model, the projections and whatever, and you put the photographs in there, and you put a little 2, 3, whatever 4-page document together. And it's an investor package. Everything about it is real, except for the fact that you don't have it on a contract. Now, you disclose the fact that you don't have it on a contract, but you say, look, here's the kind of deal I'm looking for. It'll look substantially like this. I don't have it on a contract, but why don't we talk about it, see what you think. Let me answer your questions or address any kind of concerns you have using this deal. And when I get a real deal in, it'll look a lot like this. You'll have already answered most of your questions, and you're going to be comfortable with it, and then we can kind of move forward much, much quicker. So using a sample deal package as a basis or excuse to have a conversation is a game changer, right? And so a lot of my students are now getting verbal financial commitments from investors before they even have their first deal on contract, which is huge.
Well, and just the exercise, you go through it in real life. I mean, you're putting it together so that, you have something. I mean, you're going through the process, and you're having that role play, if you will, kind of the thing where you're actually getting the opportunity to understand how the conversation works, how it flows, and what your role in that is. And I think that's awesome. You're
pretending what if, right? And the what if expands your mind. You're behaving as if you have it on the contract. And that exercise alone, like you just said, it is an exercise. It expands your mind, and you kind of move beyond what could be, and you're kind of like, oh man, because you analyze the deal, you got talk to the broker, maybe you even visit the property. All of a sudden, it becomes much more real to you, and now your confidence level goes up. And you see that confidence level go up by how others treat you. Brokers actually return your phone calls. You don't get asked to, hey, provide me proof of funds and a proof of all the units you own. You don't get those questions anymore if you appear confident you know what you're talking about. And so the sample deal package serves a specific purpose, but it has a bunch of very cool side effects.
Now it reminds me of working with my kids on their homework for their math before the test. You gotta do the exercise so you know how to do the work there. That's great.
Yeah.
So let's see here. So we've talked about basically the beginnings and kind of the mindset shift for raising money. If somebody has, they go through your exercise or they go through your program and they get this is how you engage in that conversation. At what point does it shift to, assessing or analyzing a deal, or what chicken or the egg? I mean, to me, it's obvious you got to have the money to be able to act when you find the deal, right? So do you recommend that people learn how to have this conversation first and then proceed into actually finding the deal, that matches what the type of deal that they presented, the what if? Or is it more a matter of go out and educate yourself on what all the numbers look like on a potential deal, and then translate that onto the sample deal, and then go have the conversation with the investors?
All right, so what you're asking me is that, hey, if I want to, okay, Michael, I get it. I want to get started with multifamily. Paint me a picture, right? What does this look like? What's the first step, second step, third step? Help me visualize this, right? So I kind of have my 90-day plan. Okay, I mean it goes a little bit beyond, but essentially the 90-day plan goes something like this. The first 30 days, okay, is here's what you're going to do. You're going to educate yourself. And you got to get the lingo. You got to know the theory behind it. You need to acquire the knowledge around multifamily, various aspects of it, how to find deals, what to say, how to raise the money, how to do it, how to analyze the deals, how to get it on a contract, how to do due diligence. Right, there's certain knowledge you have to acquire. Obviously, so that's the first thing you got to do.
Right.
And once you're done with that, here's kind of like my 90-day action plan. In the beginning, all right, this is what I tell my students. The first thing you got to do is you got to decide where you're going to invest, and there's a methodology for trying to figure out what area you're going to invest in. If you can't invest in your backyard, which is very common, what kind of statistics, reports, demographics, what kind of analysis can you do to help you kind of decide where you should invest? So that's the first thing. Then the second thing I have people do is kind of create, I call this the vision map. And the vision map really looks at your long-term goals and maps those long-term goals into something that you can do this week, okay? So I can spend a whole hour talking about that really. It kind of makes it, hey, I want to retire in 5 years, basically trickle down to what do I need to do this week today? That's how actionable that has to be. And then we kind of get going, right? The first thing I have people do is the first thing that people need to do is learn how to analyze deals. Okay, that's because a lot of things, it's like Gary Keller's book, The One Thing. I love this book. I actually only read it recently, and I have been doing and applying some of the techniques, but it always is helpful for someone to articulate things that you're already doing, maybe subconsciously. But Gary Keller always talks about the one thing, right? There's always one thing you should be doing in a particular area in life over a particular time frame. Right, so for example, the one thing here over the first 30 days, the one thing is to analyze deals, because he says that what is the one thing you can do that will make everything else easier or unnecessary, right? Identify what that is, and then do that, and then move on, right? So analyzing deals makes everything else easier and unnecessary. So it makes it easier, for example, when you analyze a deal, it expands your comfort zone and your mindset because you're looking at real deals, right? You get more skilled with the financials and the numbers. You're starting to use the right words. You're starting to get more confident as you're underwriting deals when you're, for example, talking about a broker, and the broker, and you're having a discussion about offer price. It also increases your confidence with regards to investors, right? So everything comes from, and of course you can make offers, right? So if you analyze a deal, you can make an offer. So there's a lot of things that come from that one thing. So the first thing I have people do is analyze 5 deals using a software that I call the syndicated deal analyzer. And once they do that, I will then have them do the sample deal package, because now they have a little bit of, they can analyze a deal a little bit, and now it's time to do the sample deal package. So that's the setup, okay? And most people can do this in somewhere between 2 and 4 weeks. That's kind of the setup. And then after that, they're going to do 3 activities. They're going to meet with potential investors. They're going to analyze deals and make offers, and they're going to build their team, right? It's just the same week over and over again. Hey, your goal is to meet with one potential investor every single week. How'd you do this week? Right? Your goal is to analyze 5 deals this week. How'd you do? Right? How'd you do? And you're making offers. When I say offers, doesn't mean you're submitting contracts. It means that you're making informal offers, either verbal or with email. Okay, you're saying, hey, appreciate this deal. This price won't work for me, but this would. How flexible is the seller? That's an offer, right? That's an offer. And the third thing is building your team. You need the property manager first. Right, so you got to talk to property managers, and you got to start building out a team of lenders, brokers. So this is the kind of activity that you do for the next 60 days. So there's your first 90 days. Now, if you've noticed, there's no deal in the first 90 days in this scenario, right?
Right.
But what it's doing, it's setting you up. A lot of it is very activity based because you're building up a discipline of new habits. So the idea being that after the first 60 or 90 days, you are continuing to do this, and the more of this you do, the more results you will get. So the first 90 days is all, for me and my students, activity-based. I just want to make sure that doing the activity, I don't care that you don't raise any money. I don't care that you don't have a deal. I just care that you do these activities as you described. And then the results come kind of naturally.
No, that's a real fundamentally sound kind of a transition progression. I like that, from a standpoint of, get your education, but, and then build up and actually become acquainted and familiar with the investors and how to analyze a deal. And then also building your network. Like you say, as you learn the lingo and stuff and are able to communicate with the brokers and 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 then have your sample deal packet ready to go. That's a great little. It's a great program. A great progression and something that's very actionable. I think that's the big thing, because I think it's one thing to go read all the books and know all the philosophies and never set the book down and go out the door or pick up the phone and go talk to somebody or walk a property and have some sort of a sense of what is it you're getting into. It can be intimidating, and at some point, mind shift, the action, it actually takes that jumping off the pier. Or there is something that you have to engage and act. Otherwise it's all just theory, and you might as well just go watch TV. So. And
I think a lot of people though are overwhelmed by this, and this is why I like the one thing so much, because I have kind of not the one thing but the next three things, right? I always tell people, hey, look, everybody knows the next three logical things to do, right? Now, if I tell you, hey, create me a plan for doing your first multifamily deal, they will go to sleep, eyes will glaze over, and they will leave, right? It's too many steps. It's 101 steps, whatever. But I said, okay, I'm going to paint you the picture. What are the next three things that you should be doing? And everybody can think of the next three things. Read a book or buy a course, go to the RIA, and, meet with a friend, and have a conversation. Whatever the case may be, right? Three things. That's all I ask for you. I don't ask for you to go figure out how to do your first deal. I said just do the first three things. And you write them down, you knock them out, right, in a week. And then you put down the next three things, okay? And you repeat this week after week. And all of a sudden you look up after like 2 months, you're like, holy cow. Look at everything I've done. And it's only because you always focused on the next three things.
Right. No, I think the other thing that I recognize is just that the number of deals you actually have to analyze to actually find the deal. It's one thing to go to LoopNet or whatever and see the deal, and you can find a property, but is it a quote deal that fits your parameters or whatever, and being comfortable and having that experience to really be able to recognize when it is an opportunity, as opposed to getting all excited about something that's not an opportunity, and developing that patience and the discipline, and to be able to really recognize the deal.
But patience is a problem, right? Isn't it, though?
All right.
But that's a real problem with multifamily, right? Because of the patience thing. It could take you a long time to do your first deal.
Right.
And that's a real challenge, which is why, and you said it earlier, if I can't convince you to kind of go bigger, right, to get you closer to where you go faster, if for some reason you can't wrap your head around it, then I will go to plan B. And plan B is go get a daggone duplex. Okay,
right.
I've done it kicking and streaming, but I've come to the conclusion it's better that you go after a duplex than you not do it at all, right? And so I've actually adjusted my, 25 plus unit strategy to a duplex strategy, just so I can give people, hey, look, you don't have the patience for doing this, the way I would suggest you do it. That's fine. Let's go to plan B. Because with a duplex, you don't have a lot of the challenges. Duplexes you have all over the place. In most of the countries, you can do this. They're easy to find. And they're easy to manage. They're easy to rent up. There's a lot of things that are easy about them. You don't have to raise a lot of money for them. So before you go away and abandon the multifamily strategy, go get a duplex. And that you can do in 90 days. Yeah,
no, exactly. They're certainly a different animal. It's basically like a house. Only you've got two two potential incomes. If one of them leaves, then you still have one of the two. But yeah, that's I do like the fact that you don't let people either, or it's not an all or nothing, that there is the we can step you down if you're not comfortable going larger than go smaller. What is there a size of a deal that you recommend? Maybe you said this, I didn't hear it. Is there? I think you indicated your first one was like a 12 unit property. Is there a number that you recommend or that you see people start out with that's a kind of a common, a good level to look for?
No.
Okay.
Here's why I say this, because it really depends. It really depends on the circumstance. It really depends on a person. For example, the one guy you said that got 130 for a unit in Texas, which was his first deal. He was able to do that deal. He raised a ton of money. Okay, he raised 2.1 million. He put like 150,000 in himself, so he had some capital and he had a network. But he hustled to raise that money. Now his financial goals are much higher, right? They have another zero at the end than most of our financial goals. So as far as he's concerned, he's 25% of the way there with this deal. Okay, that's how serious he is. So it really depends. The way I would do it is you got to look at your goals and you have to look at your current circumstance. Okay, what I mean with that is your goals. Let's say you want to achieve $10,000 per month in income, and this is not a made-up number. This is a number that is a meaningful first milestone. I mean, everybody wants $1 million per month, but who cares, right? The real thing is the first milestone normally is, hey, how much money would I need coming in each month so that I could quit my job, for example? Now, that may or may not cover all of your living expenses. Maybe it covers 75% of your living expenses, and at that point, you can jump ship. Right? Or it covers your minimum living expenses, whatever. What is that number? And I call that the rat race number, right? What's that? Okay, that is your first meaningful milestone. And let's work backwards from there. So you should try to get to that number, that first meaningful milestone, within 2 to 3 deals. Okay? So if that for some reason that rat race number is $5,000 a month, you can get there probably controlling around 50, 60 units, with assuming you don't put any of your own money in the deal. So that's kind of the way it's working out right now. So if I need to control 60 units to get to that number, what is a good first deal size? And then now you have to compare that with your circumstances. Do you have any of your own money? What does your network look like? How skilled are you at speaking and communicating, right? I mean, who are you and what do you have to work with, right? So I have guys come up to me, I want 1,000 units in the next 12 months. But they don't have 2 pennies to rub together, and they don't know nobody with money. I said, dude, I applaud you for thinking big, but let's be real here, okay? You have a disconnect between what you think you want and what you can realistically achieve. Right. So you have to find a balance. But in this particular case, let's say, the guy has $10,000 somewhere, and he can use that money to invest in his education, maybe pay for a deposit or some due diligence costs or whatever else. So 50, 60 units, the first good deal might be a 10 or 15 unit, something like that. Great deal. Italy, even a duplex, okay? Even a duplex would qualify because the thing that's critical in your path is your first deal. We talked about the one thing. Well, the one thing in a bigger picture is your first deal, right? That's your one thing. And at this point, I used to say, well, it should be a deal at the edge of your comfort zone. I'm not even saying that anymore. I'm saying, you know what? I'm going to push you as far as I can. And then we'll go from there. But if I can't push you, then we will do a duplex, and that'll be your first deal. I got a guy interviewed on a podcast 6 months ago. It took him, no lie, 24 months to buy a duplex. I mean, He was analyzing and careful and conservative, and he was hemming and hawing, and he finally bought a duplex. I'm like, congratulations, good grief, are you serious? But then 3 months later, he closed on a 32 unit. Wow! And then he quit his job. Right? Okay. First deal. So from my perspective, coaching people, my goal is to get you into a first deal. And I don't really care what size it is. Now, the bigger it is, the more if you're further along. But if I can't get you there, then I'm going to put you into a duplex. But if I had a magic wand, I would put you in a 10 unit first, okay? And then once you do that 10 unit deal, I can guarantee you the second one is going to be much larger. It'll be at least 25 to 30 units. And then the third deal, I don't even know where it's going to be. It could be in the 75 to 100, whatever. So I'm saying within 2 and 3 deals, you will be at the number that you want or higher. But it all hinges on that first deal. Yeah.
No, I'm curious on the guy that was the number analyzer there 2 years in. What's the is it a risk tolerance, or is it just the fear of the unknown? I mean, you have other people that just like, okay, 90 days, I want 1,000 or whatever it is, but they're action oriented. Can you talking about mindset? Is there anything that you can identify that really speaks to that?
This was Jay Boyle, and I gotta say, I think he was definitely action oriented. That's not what it was. I think he was just very careful. Mm-hmm. He was very careful, and he wanted to really know every single duplex and he wasn't even covering like a city. He was covering like, I don't know, an area, okay? He just wanted to really, really know his market. That's what he wanted. He was very, very careful. But he was still very action-oriented. He analyzed, dozens and dozens of deals. So it wasn't a lack of action. He was just very cautious. And that's fine. That's fine. I have less of a problem with that. He still did his first deal, and he was taking action. This is why I'm saying to me, it's a little less about the outcome and more about the activity, because if you don't take action, I will hold you accountable, and I'll get in your face and say, there's no way you're going to get there if you don't take action. Now, if you don't get the results from your action, then you got to kind of scratch your head and go, okay, what do we need to do? What do we got to do? But if you're not taking action, that's a problem.
Got it. No, that's that first deal. I've heard that numerous times, and I think it's one that everybody can tell. I mean, everybody I've talked to can tell about their first deal. I mean, that's the one that, whether it be a hurdle or just that all the lessons they learned or whatever, but just that confidence to move on beyond that, it's a big deal. So that's great.
Yeah.
Well, I'm just. I mean, everything we've talked about here, just the starting in the single family and kind of the mindset and the process for learning, getting the education, analyzing the deals, talking with potential investors, doing your what do you call it? Your practice deal, your sample deal packet. I mean, it's very action oriented. There's a natural progression. I love that. The whole thing about that, and then the actual raising the money and stuff. You can see how it works, and I think that's what's really impressive about what you're all about there.
Yeah.
Michael, I know you've got a deal analyzer and a couple other things that you have as far as tools that people can access. Is there a way they can do that?
Sure. The best way to get all this stuff is going to my website, which is themichaelblank.com. That's and then Michael, and then BLANK, themichaelblank.com. And I would start with downloading the ebook on raising money. It's called The Secret to Raising Private Money. And in the appendix, I actually include a sample deal package in there. So I describe this in a little more detail, and that's themichaelblank.com/ebook. And I'll keep you busy for hours with my blog articles, YouTube channel, and podcast. And when you've had enough of that, then we do have a syndicated deal analyzer and a course and all that stuff. But I'll keep you busy for weeks with the free stuff. And if you want more, then we can talk about that as well.
Well, and I will endorse or encourage anybody that has enjoyed this to definitely check out your podcast, and all your material that I've checked out is well thought out and well presented, and I would encourage anybody interested to check it out. Michael, thank you so much for taking the time today, and I look forward to talking again soon.
Thanks so much, Darren.
All right. I hope you enjoyed Michael as much as I do. I think he's a very clear thinker. He's just a tremendous wealth of experience and knowledge, and he provides just such a clear path of action that builds on confidence and gets results for his students. And every time I listen to him, I find him to be a breath of fresh air and just very clear, concrete steps to take, and he's constantly able to break things down and provide details that make complete sense to the listener. So also, if you haven't, I encourage you to go check out his website. It's The Michael Blank, and you can check the show notes here on the show here for the link there, but it's themichaelblank.com. That's all we have for today. We know you're busy. We thank you for making time for us today. We do appreciate you. Until next time, thanks for listening to Commercial Real Estate Pro Network's CREPN Radio.
You're listening to CREPN Radio for influential commercial real estate professionals. For more information on this or any of our guests, like us on Facebook, CREPN Radio.